My name is Ariella. These are my group mates, Nicole, Kevin, Wei, and Noreen. Today we'll be presenting a brief financial analysis of American Eagle and The Buckle. As investors, we will be sharing our educated recommendation on which is the best company to invest in. Through analysis of the income statement and balance sheet, we were able to use ratio analysis to see the profitability, liquidity, and efficiency of each company. So we will begin with American Eagle, and then we'll move on to The Buckle, and then we'll provide a comparison of the two.
So first we looked at current assets, and current assets are assets that are going to benefit the company, specifically American Eagle, within a year. So total amount of current assets for American Eagle were $1.14 billion. Total amount of total assets were $1.75 billion. That makes a 0.65 ratio of current assets to total assets. The current assets were cash and cash equivalents, short-term investments, merchandise inventory, assets held for sale, accounts receivable, prepaid expense and other, and deferred income taxes. Our current liabilities are liabilities that are owed for the company. American Eagle owes within the year. So total current liabilities for the company were $435 million, while total liabilities were $534 million, which is a 0.81 ratio. The current liabilities are accounts payable, accrued compensation payroll taxes, accrued rent, accrued income and other taxes, unredeemable gift cards, and gift certificates, current portion of deferred lease credits, and other liabilities and accrued expenses. So we looked at assets and liabilities related to adjusting entries, and which is based on accrual basis of accounting. The assets which were related to adjusting entries were short-term investments, merchandise inventory, assets held for sale, accounts receivable, prepaid expenses and others, deferred income taxes. Liabilities were accounts payable, accrued compensation and payroll taxes, accrued rent, accrued income and other taxes, unredeemable gift cards and gift certificates, current portion of deferred lease credits, and other liabilities and accrued expenses.
So we used the balance sheet to find the change in retained earnings. And retained earnings, as we know, is the percentage of net earnings that is not paid out as dividends. And that money can be put back into the core business, or it can be paid as debt. So we took the 2012 balance and then the 2013 balance, and all you have to do is subtract it. And the change was a negative $218,406. So net income as of 2013 was approximately $232 million, and all profits from that flow through retained earnings and losses are essentially anything that can change the net income. And lastly, we have the dividends paid during the year. So we have, as you see, something called the reissuance of treasury stock. Basically, it's a stock that the business it buys out. And a reason why a business would do so is that if they felt like their stock was undervalued on the market, they would buy out that stock. So essentially, it would decrease the number of outstanding stock on the market. Another reason is because capital gains are treated more favorably. So as a tax-efficient way to pay out shareholders, they would reissue a treasury stock. So to find the dividends, you would find the change in net earnings, and then add the income, and then subtract things such as treasury stock, where we find that the dividends paid out were $414 million approximately.
So next is The Buckle. Their current assets include cash, receivables, inventory, and prepaid expenses. And current assets basically mean that they're expected to be converted to cash in order of 1 year. And it's also listed in order of their liquidity. And the total amount of current assets for The Buckle right now is, for 2013, is over $270 million. And the total asset for 2013 is over $470 million. The current to total asset ratio is 0.58. And the higher the ratio is, the better, because those assets can be converted to cash within 1 year to pay for current liabilities and current bills that are due for The Buckle. Next, we have current liabilities. They include accounts payable, employee compensation, and store operating expenses. In contrast, current liabilities are basically bills that are due to its creditors and suppliers within 1 year. And the Buckle currently has over $128 million of current liability and over $180 million of total liability. And the current to total liability ratio is 0.68. That means Buckle has to pay more than half of its liability to its creditors and suppliers within 1 year. Next, we have assets and liabilities related to adjusting entries. They're basically current assets and current liabilities without any cash. Like they mentioned earlier, cash is never included in adjusting entries, or else it'll be cash basis accounting instead of accrual basis accounting.
So we also look at Buckle's change in retained earning. The reason we look at it because is from retained earning from 2012 to 2013, we can know how Buckle doing well from last year to this year. So the balance of retained earning from in 2013 is over 170 million, and in 2012 is over 260 million. However, we find out the change in retained earning is negative 90 millions, which means from last year to this year, from 2012 to 2013, Buckle has a negative retained earnings, so they were doing bad in this year. It also means that they have losses retained more than accumulate net income. Also, when we look at their income statement, we find out that their net income is 164 million. And next, we also have to look at their dividend paid during the year. So we go back to the accounting basic formula. Dividend is equal net income subtract retained earning. However, 2013 is not the beginning years, so we have to add the retained earning in 2012. So we find out the dividend in 2013 is over 250 million.
Here you can see the comparison of the two companies' current assets to total assets ratio. As you can see, American Eagle has the higher ratio, and for American Eagle is an advantage because current assets are able to be used within a year to pay off their current liabilities, and they're also able to convert them into cash. On this slide, you can see the current liabilities to total liabilities ratio, and the American Eagle has a higher ratio. This gives them a disadvantage because it shows that they have more current liabilities to pay off within a year. The dividend payout ratio is the dividend paid during the year over their net income. As you can see, the American Eagle has a higher ratio of 1.78. A reason why is because American Eagle is doing well and they want to give back to their shareholders. As you can see, their net income over the past 2 years is an increasing trend. In conclusion, we recommend investing in American Eagle because based on our findings and also because American Eagle is doing well.
Thank you.